Hello class, welcome to our lecture on perfect competition in our course on principles of microeconomics. To give us a roadmap of what we're going to discuss in this lecture, we're going to start by talking about market structures. Perfect competition is essentially the first of four market structures that we're going to discuss in this course, so it's good to kind of talk about what they are before we go into a specific example, which is going to be perfect competition. We'll talk about the concept of being a price taker. We'll talk about the unique situation that a perfectly competitive firm has in terms of its demand curve. We'll talk about how perfectly competitive markets maximize profits. We'll talk about the shutdown rule, which is something that we analyze when a firm is not making money in the short run. And then we'll talk about the long run outcomes for a perfectly competitive market. So I'll preface this lecture by talking about the four major market structures that exist in our course. The first one is perfect competition. That's what we're going to be talking about in this lecture. There are three other market structures that we can discuss. The first one is monopolistic competition. The second one is oligopoly or oligopoly. And the last one is monopoly. So essentially, how we break these market structures down is all of them are going to have the same way in which they'll maximize profits, but they're going to have different interactions with the competitors that they have, if they have any competitors to speak of, because in a monopoly you don't have any competitors. However, we'll talk about the relationships and how these structures are formed essentially based on the barriers to entry, the number of buyers and sellers, and kind of whether the product is differentiated or not. That's essentially what's going to differentiate these four market structures, but there are implications of each even from that basic paring down. So the market structure we're going to talk about here is a perfectly competitive market. So a perfectly competitive market is characterized by three things. So again, it has to do with the number of buyers and sellers, the differentiation or lack thereof of a product, and how easy or difficult it is to enter the industry as a new firm. In a perfectly competitive market, there are many buyers and sellers. The product that they're selling is indistinguishable, or as we like to call it in economics, homogeneous. Essentially just means it's the same product, and that it's easy to enter the industry as a new firm. So this doesn't mean it's easy to be successful or it's easy to make profit. It just means that it's easy to start out because the costs are relatively manageable and not prohibitively expensive as you would see in potentially an oligopoly. The unique circumstances that associate with this. So again, it doesn't seem like it's very complicated in terms of its analysis. There's lots of buyers and sellers. They're selling the same product, and it's easy to enter. But these characteristics provide a unique circumstance in which all perfectly competitive firms and essentially all perfectly competitive consumers in the industry are what are known as price takers. And a price taker is an individual that has no control over setting the price in the market. It is completely up to traditional market forces that result in a market equilibrium that dictates the amount of a good or service that's produced in the market and the price that it's sold for. There is little to no ability to influence the price as a perfectly competitive firm. The unique reaction to that is that our demand curve for a firm in a perfectly competitive market is not going to be downward sloping, but rather it's going to be horizontal. So a perfectly elastic demand curve. Some examples of a perfectly competitive market, the main one that you're going to look at in terms of what your textbook might talk about, or if you look at examples on the internet, is agricultural commodities. So wheat, soybeans, corn, things like that. It's very ubiquitous in society. There's a lot of it. Lots of people make it. Lots of people consume it. And because of all those forces together, combined with the fact that it's almost indistinguishable when you throw a bunch of grain into an elevator from different farms to distinguish between one grain of wheat and another wheat kind of stalk, effectively it renders the firm incapable of dictating a price for it. And so we believe that because corn is ubiquitous, wheat is ubiquitous, soybeans are ubiquitous, and it's hard to distinguish between them, and there's lots of people that buy it and a lot of people that sell it, that is in a perfectly competitive market. The image to the right of the slide is of the West Side Market in Cleveland, Ohio. So this is a open air farmers market that is open 5 days a week, just west of downtown Cleveland, across the Cuyahoga River, known in a neighborhood known as Ohio City. And effectively, there are dozens to potentially hundreds of vendors selling effectively the same fruits and vegetables right across from each other. And so a farmer's market can be a good example of a perfectly competitive market, because you really can't necessarily set your price on a product when someone across the way is selling it for less. Because if it's an indistinguishable product and there's no transaction cost from turning your body and buying it from someone that's selling it for cheaper, you don't really have influence over the price as a seller. The last one is foreign exchange markets and currency markets. So again, currency is ubiquitous. So if you're trying to buy yen or you're buying dollars, one person's dollar is indistinguishable from another person's dollar. And so there's a lot less influence because there's so many people transacting that currency at any given point in time that you don't necessarily have a lot of influence over the price. So those are considered examples of perfectly competitive markets. Are they truly, truly perfectly competitive? No, there's some frictions in those markets that result in it not being exactly as it follows in the theories I'm going to teach you, but essentially it's close enough where we can kind of treat it as examples of such. So how do we end up with a market graph for an individual firm in a perfectly competitive industry? Well, as I mentioned before, firms are price takers. So since they cannot directly influence the price is going to be determined by the market. And so on the left, we have a graph that indicates the market for wheat. And in a traditional situation where we have the downward sloping demand curve and the upward sloping supply curve, the market equilibrium point is going to occur where quantity supplied is equal to quantity demanded. At that intersection point, we see that 2.25 billion bushels of wheat are going to be produced across the entire market. So one firm will not produce all of that. One firm will not even produce a fraction of that. Well, I mean, it'll be a fraction, but not a discernible fraction of it, which means they can't influence the price. And there's just so much of it that if you decide to make it, pretty much there's going to be no limit to the amount of demand for your product, because you'll never be able to make enough to fulfill the overall market demand. And then secondly, if we look over, the equilibrium price is $7 for that bushel, which is what the price the firm is going to sell it for is going to be. If they charge more than that, they will sell nothing. If they charge less than that, they'll sell just as much as they did at $7. The only consequence will be is when we bring in marginal cost, you'll see that the profit maximizing level of output would be lower, and you would actually make less money by charging a lower price than you would by just taking the prevailing market price of $7. As I mentioned before, we have a horizontal demand curve, and if we think back to our discussion on elasticity earlier in the course, perfectly elastic demand implies a elasticity of infinity, or a price elasticity of demand of infinity. And so what does that mean? That means that quantity demanded is infinitely responsive to a change in price. What that means is effectively that when you increase the price above the market price, because you have so many other competitors that are easy to purchase from besides yourself, then effectively you will sell nothing. So think about to that farmer's market that I showed you just a few minutes ago. If you're trying to sell oranges for $1 a pound and someone next to you and someone across from you are selling it for 75 cents a pound, then there's no way that someone's going to buy from you because they could just turn and buy it from someone else. So you're stuck charging the actual wage, or excuse me, the actual price that the market has dictated. Now, again, you could charge a price below the market wage, and then everyone will want to buy from you. But when we compare marginal revenue to marginal cost to determine our profit maximizing level of output, it's going to turn out that our profit maximizing level of output is going to be less than if we charge that $7 in the wheat example. And as a result, you'll make less money. And so even though everyone will want to buy from you at that point, you won't make enough to fulfill the full demand, and you will actually make less money than at the prevailing market price. So that's what we mean by infinite responsiveness. Because yeah, demand, you can, because there's so much demand for the product, you can already have that effectively in infinite demand at the market price as it is. So there really is no reason or incentive to lower the price in a perfectly competitive structure. Profit maximization is, again, one of the most important keys to this last, it's not the last unit, but one of this major unit in terms of market structure in the course. The reason being is because of the fact that profit maximization goes back to that marginal analysis thing we talked about at the beginning of the course. Optimal decisions are made using marginal analysis. And the optimal decision when you've decided to engage in an activity is to continue that activity to the point where marginal benefit equals marginal cost. Marginal cost has been well established as the additional cost of producing one more unit of a good or service for a firm. Marginal benefit is going to be marginal revenue, which is the additional revenue that a firm receives from selling one more unit of a good or service. So, the profit maximizing level of output, again, because profit maximization is the optimization problem for a firm, maximizing their overall revenues relative to their overall costs, is to produce until the point where marginal revenue equals marginal cost. So once we find the point where marginal revenue and marginal cost are equal to each other on the graph or at a table or in an equation, we have found the optimizing quantity to produce at and the optimizing price to sell for. Now, in a perfectly competitive market, we're operating with a horizontal demand curve instead of a downward sloping demand curve. So if that's the case, then instead of us really worrying about what marginal revenue is relative to demand or relative to price, which we will talk about in great length when we talk about monopolistic competition and the other market structures, for a perfectly competitive firm, because of the fact that your demand curve is horizontal, you're going to have a situation where your marginal revenue is just price. If you think about a horizontal demand curve, if you're selling a bushel of wheat for $7 every single time you sell a bushel of wheat, then that means that marginal revenue is the additional revenue from selling one more unit of a good or service. So if you sell one unit, it's 1 times 7, which is $7. If you sell a second unit, it's 2 times 7, which is 14. Well, if you take 14 minus 7, that's also 7, which is just the same as the price. You sell a third unit, you're at 21, so 21 minus 14 is 7. So the marginal revenue is always going to be equal to the price. So if that's the case, and the demand curve always dictates the price. So in subsequent lectures, we're going to talk about how marginal revenue is different than price, and the demand curve actually determines the price, not marginal revenue. Marginal revenue determines quantity. Demand curve at that point determines price. Well, since we have a horizontal demand curve, price is equal to marginal revenue, so our profit maximizing level of output is going to occur at the point where price equals marginal cost, which is going to be the point where the demand curve, the horizontal demand curve, intersects the marginal cost curve, which again is the de facto supply curve for a individual firm. So here's an example of a perfectly competitive industry. We have a situation where we have a horizontal demand curve, so that implies perfect competition. And then we have our upward sloping marginal cost curve, and we have an upward sloping average total cost curve. Now, the reason why average total cost curve is included in here is because of the fact that in order for us to determine whether the firm is making money or not in terms of positive, negative profits, or breaking even, we have to compare the actual price to the average total cost of the production process. Because remember, profit is equal to total revenue minus total cost. Total revenue is price times quantity. Total cost is just going to be average total cost times quantity, because average total cost is total cost divided by quantity. So if you cancel out the Q's, you get total cost. So we can directly compare a per unit profit by comparing price to average total cost at our profit maximizing level of output. In order to determine the profit maximizing level of output, we need to find the point where marginal revenue equals marginal cost. Again, in a perfectly competitive firm, because of the horizontal demand curve, marginal revenue is equal to the demand curve. So where the demand curve intersects the marginal cost curve, so where that blue horizontal line intersects the red marginal cost curve, is going to determine our profit maximizing level of output, or Q star. The price in a perfectly competitive market structure is no mystery. It's just been determined by the market price and market equilibrium, so there's no guessing as to what the price is going to be. In subsequent market structures, you'll have to figure out what the price is going to end up being, whether it be through a similar graphical analysis or game theory or something of that nature. So we have a situation here where the intersection point determines Q, price is already given away. So now the question becomes, is the firm making money or not? Well, in this example, we won't be able to calculate a specific dollar amount, but if you want to calculate profit on a graph like this, you just take the equilibrium price, the profit maximizing price, subtract average total cost at the profit maximizing level of output. So notice how ATC is varying at a bunch of different points. We only care about average total cost at Q star. We don't care about it at any other point but at Q star. So the point we care about it at is right here. So that's going to be where we determine average total cost to be. If we subtract P minus ATC, we know that ATC is below price, so we know that it's going to be a positive number, so we actually have a positive level of profit. And so that green rectangle that's indicated on the graph actually is, that shaded region indicates the overall profit for the firm at this profit maximizing level of output. So it's price minus average total cost times quantity is our level of profit. So let's say price is $7 still, average total cost is $6.50, Q is 100. So then that means that 7 minus $6.50 is 50 cents times 100 units. The firm is making $50 in profit. The question then becomes, if a firm is losing money, should they stay in business? So your gut instinct might be to say, no, they shouldn't stay in business, because why would I go into business if I'm not going to make money? The problem with that logic is that most firms are going to be losing money at the beginning of their operations because they have high fixed costs. They have taken out a substantial business loan or commercial loan to front the build out of the facility or to buy the property, or buying new equipment all at once in a capital investment project. And so it's going to take time to pay that debt down, or whatever fixed costs that they have up front. And so even if a firm is losing money, in the short run, it does not necessarily mean it is grounds to shut down and go out of business. If it's in the long run, yes, because as we learned in the last units, in the long run, you can vary all of your inputs. In the short run, you have fixed inputs. So in the long run, if you're varying all your inputs and you still can't find a way to make money, then you're in the wrong business and you should go out of business. In the short run, though, it could be because of your high fixed costs, you're losing money until you get out of that debt. So, in order for a firm to stay in business when they're losing money, we have to go to what's known as the shutdown rule. And the shutdown rule then, instead of comparing price to average total cost, is going to compare price to average variable cost. Because remember, in the long run, average variable cost is average total cost, and those fixed costs won't be there anymore. So if a firm is charging a price that's higher than the average variable cost, then that means that eventually, once those fixed costs go away, they will be making a profit at the extent of the difference between P star and AVC. Now, if at that point where marginal revenue equals marginal cost, price is less than average variable cost, then that means that the firm is actually incurring higher debt and higher costs at a profit maximizing level of output than if they produced zero. And if that's the case, then they should just shut down, because they would actually, even though they're going to lose money by shutting down, they're going to lose less money by staying in business. So here's just another explanation for that. So again, short run, there's fixed inputs. Long run, there are no fixed inputs. So that's the big difference between the short run and the long run. So if you're losing money in the long run, shut down. If you're losing money in the short run, go to the shutdown rule and figure out, okay, well, is my average variable cost lower than my price? Because if it is, then I should stay in business. But if it isn't, then I should shut down, because I would actually cut my losses and lose less money by just paying for all the fixed costs up front than dealing with the additional loss of producing a product at a loss on top of the fixed cost loss. So here's an example of the shutdown rule, or an example of a perfectly competitive market structure. So again, to figure out whether or not a firm is making money, we have to first figure out what is the profit maximizing level of output and what is the profit maximizing price. Now, there's no shock here as to what the actual profit maximizing price is going to be. It's $6 because that was determined by the prevailing market price and their price taker, so they just took $6. Now, our marginal revenue equals marginal cost is going to be at the point where 4 basketballs are being produced. So that's why you see that intersection point there, and we're going down to 4, so that's our Q star. Unfortunately, average total cost is $8.50 per unit, which means that the firm is losing $2.50 per unit times 4 units, so the firm is actually losing $10. So the question then becomes, should this firm stay in business? Well, in order to answer that, we have to default to the average variable cost curve. The average variable cost curve at 4 units is also $6, which means that marginal revenue, or excuse me, price, which are the same and perfectly competitive, the price is the same as average variable cost, which means that in the long run, when those fixed costs expire, the firm will break even. So in a case like this, we would have the firm stay in business. Even though the firm won't be making money when those fixed costs expire, they'll at least be breaking even. And so one of my old professors said, well, just if a firm is breaking even, well, why shouldn't they just go out of business too? Because like, what's the point of being in business to like just make no profit? Well, the question there is, if you start a business and you hire workers and you're paying yourself wages in the process of that cost of production, then there's benefit to you. So if you're paying yourself $60,000 to run the business, and with that $60,000 salary you pay yourself, you're making no money, well, you're still making $60,000 a year as an employee, and that's a job that wouldn't exist if your business just went under. So there are benefits to staying in business even as a break-even company that you have to kind of think about to see why it's so important to stay in business even if you're equal to your average variable costs in the short run. So the question then is, what happens in the long run? What is the potential long-run outcome for a perfectly competitive firm? So for a perfectly competitive firm, the assumption is that the firm will make zero profits or break even in the long run. So again, there are benefits to breaking even, especially if you're paying yourself money or you're providing jobs for your local community and it helps boost the economy. Now, in the long run, in the short run, you could make profits. And even in the long run, you could still potentially make profits depending on a certain number of factors. But generally speaking, the theory suggests that in the long run, the firm will break even. And the reason for this is as follows. The left-hand side of the graph in the image shows you the market for carrots in this example. So before we were doing bushels of wheat, now we're doing boxes of carrots. Well, if it's easy to enter the industry, as is assumed in perfect competition, and people see that people are making money by entering or in that industry, then people are going to enter that industry. There's nothing barring or preventing them from entering. There's nothing blocking them from entering. And there's benefits because of the fact that there's profit to be had. And so what ends up happening is that it increases the number of firms producing, which increases the supply for the market, which is going to shift our supply curve from S1 to S2. And when S1 shifts to the right to S2, that's going to create a lower market equilibrium price of $10 instead of $15 for that box of carrots. Now, if you were operating under the situation where you were charging $15 for a box of carrots, well, your MR equals MC and your price equals MC at 10,000 units. And at 10,000 units, average total cost is, say, $11 or $10.50. So you're making $4.50 a unit times 10,000 units. That is a very, very healthy profit of about $45,000. I'll take that business. And that's for one farmer, Farmer Gillette. Now, if all these other people are like, well, if producing carrots is going to make me 45 grand in profits, then why shouldn't I get in the business too? So they do. They enter. And unfortunately, by them entering, it pushes downward pressure on the price to the point where it's 10 bucks. And unfortunately, at $10, the profit maximizing level of output is 8,000 boxes of carrots instead of 10,000 boxes of carrots for Farmer Gillette. And so he ends up producing at that point, an average total cost of that specific quantity is $10. And so the firm is actually breaking even. Now, it's not this smooth in reality because there's going to be entry and exit on both sides. So there could be a time where the market gets flooded so much that that price goes down to $9. Now, for Farmer Gillette, his average variable cost in a specific unit of time might be lower than, because he's been in business for a while, than someone who just entered. And if they're losing money pretty quickly, they're going to leave the industry. And when people leave the industry, that shifts the supply curve back to the left and puts upward pressure on prices. So there can be this endless game of I'm making money, then people enter the market, and then they push pressures down where nobody makes money, and then they leave, and then that takes pressure off, puts upward pressure on price, and that results in people making money again. And there's this endless flow, and the assumption is that like the net gains over that endless flow is zero. That basically you cancel each other out over that long period of time. And so the long run assumption is that perfectly competitive firms will have zero profit because of firms entering the industry, because they're not blocked and they're selling a undifferentiated product. So that concludes this lecture on perfectly competitive markets. So some important takeaways are to understand what are the characteristics of a perfectly competitive market, how to basically analyze and do an optimization problem for a perfectly competitive firm by finding the point where marginal revenue equals marginal cost, figuring out how much they're producing, how much they're selling is not a or how much they're selling it for is not a mystery, but how much money they're making, and if they're not making money, should they stay in business, and in the long run, are they making money or not making money? So if you have any questions, just feel free to reach out to me. I'm available for questions, and good luck on your assessments and any other courses that you have at this point in time.